WorldCom, the leader in globally managed VPN solutions on the world's most scalable global IP network. WorldCom.
In the summer of 2002, WorldCom, the second largest telecom company at the time, was thrust into a major scandal when the firm's internal audit unit, led by Cynthia Cooper, the company's vice president, uncovered a massive inflation of earnings, with over $3.8 billion in fraudulent balance sheet entries and assets being overstated by over $11 billion. To discover how the company was able to maintain this false image, and how they were able to prey on consumers and potential investors such as yourself, stay tuned, and make sure to hit that bell and subscribe icon below. This is the evil economics of WorldCom. WorldCom was founded in 1983 as a discount long-distance telephone service. It was established on the heels of an AT&T monopoly breakup by founders Murray Waldron, William Rector, and future CEO Bernie Ebbers. The courts that ordered the AT&T breakup mandated that the company lease their long-distance lines to new companies at low rates. The long-distance lines allowed customers to speak with friends and family and conduct business in other states. WorldCom took advantage of this, and under the leadership of CEO Ebbers, became one of the nation's leading telecom companies, which would acquire through mergers and acquisitions over 30 competing entities and would really reach a peak market capitalization of over $186 billion. In 1999, while WorldCom was at its peak, a merger with the Sprint Corporation was discussed. Had the deal gone through, the resulting combined force of Sprint and WorldCom would have been the largest telecommunications firm at the time. However, efforts from the European Union and the U.S. Department of Justice caused the deal to fall through. These organizations were prompted to act due to concerns that Sprint and WorldCom would create a monopoly, much like AT&T had before it. Following the collapse of this merger, fraud would be uncovered by the company's internal auditing department. The tech boom ended with the dot-com bubble bursting in 2001, and companies began cutting expenditures in telecom services and equipment as a result. WorldCom's earnings went into the negative. To prevent the company's stock price from tanking and to hide the losses from the board of directors and investors, the company began using questionable accounting techniques to hide them. One method was to record line costs, the interconnection expenses with other telecommunications companies, as capital expenditures, reclassifying them to being long-term assets which would be written off over 20 years rather than in the current quarter. Bogus journal entries were also created to inflate the revenues using corporate unallocated revenue accounts, which would mean that they claimed to have received cash for the transaction when they hadn't. The resulting fraud led to the company reporting $1.38 billion in revenue, when in reality they were taking over $2 billion in losses. The primary orchestrator of the fraud at WorldCom was CEO Bernie Ebbers, who owned a large quantity of stock. He was also in a bind with a stockbroker who made a margin call insisting that Ebbers invest more money into his account, and as a result, Ebbers used his influence at WorldCom to get them to give him a loan for almost $500 million, so he wouldn't have to sell his stock in order to make the margin call. For this reason, it was beneficial for him to have the WorldCom stock remaining really high in value. For people looking to invest their disposable income, however, the high stock price and profits WorldCom were reporting proved to be disastrous. Those who spent their hard-earned dollars on WorldCom stock would see their investment fall from $61.98 a share to only 8 cents a share following the uncovering of this scandal, a drop of over 99%. So the investments at that point were virtually worthless. Many who had invested in 401k or mutual funds would feel a massive fallout from the scandal as well, as these entities would have invested in WorldCom on the individual's behalf, believing in the false narrative that was put out by the company's top brass. The biggest losers in this fraud, however, were the employees of WorldCom, many of whom found themselves jobless and had invested heavily in their employer's stock as it had been soaring in value. The fraud at WorldCom proved to be the final nail in the coffin for auditing firm Arthur Andersen. Auditors at Arthur Andersen were colluding with the Enron executives to inflate their revenues. This time around, there wasn't any collusion proven between the accounting firm and WorldCom. However, the fact that they were involved in such a large scandal the year prior, only to give the thumbs up on WorldCom's financial statements the next year when they were committing an even larger fraud, looks pretty bad for the auditing firm. It would be in June of 2002 that an internal audit of WorldCom's capital expenditures would expose the fraud. The team was led by Cynthia Cooper, and they would hone in on entries for prepaid capacity. Prepaid capacity referred to expenditures on landlines in low or sometimes even no-use zones. When the company's controller, David Myers, was questioned by Cynthia and her team, he would admit that the entries had no backing from any financial accounting principles and should not have been made. Myers stated that the entries were based on what we thought the margins should be, indicating they were basing their income on what it would have been had the dot-com bubble not occurred. Once it was established what the entries for prepaid capacity were, the company's top brass scrambled to try and find capital expenditures that had been mistakenly entered as expenses to try and offset the massive whiplash that would be caused by them having to restate their earnings. However, the 49 entries that had been uncovered by Cooper and her team totaled over $3.8 billion, and there just wasn't finding that amount in their books. And a short time later, the Security and Exchange Commission, or SEC, took over the investigation. David Myers resigned soon after, and Scott Sullivan, the CFO of the company, was fired when he refused to tender his resignation. On June 26th of that year, the SEC would file civil fraud charges against WorldCom, alleging that senior officials in the company had conspired together to manipulate earnings in order to maintain its stock price. The fraud at WorldCom would replace that which had occurred at Enron only the year prior as the largest in United States history. Blame for the fraud was placed squarely on Bernie Ebbers, the company's CEO. Ebbers would receive a 25-year prison sentence for his involvement. He would, however, only serve 13 years in prison, his lawyer citing failing health for early parole, and he would pass away less than a year later. CFO Sullivan would receive only 5 years in exchange for testifying against Ebbers, and the company's controller, David Myers, would receive an even more reduced sentence of only a year and a day in exchange for his testimony. Cynthia Cooper, for her actions, would be named Time Magazine's Person of the Year in 2002. She would go on to start her own consulting firm following the bankruptcy of WorldCom. Thank you for taking the time to watch this presentation from Evil Economics. We hope that you enjoyed it, and if you haven't already, please hit that bell and subscribe icon below and leave us a like. We hope to see you in the next one.